Interest rates are up, inflation is up. What's the difference? And how do higher interest rates affect you? Hi, I'm Steve Wershing, and welcome back to 30-Minute Money. This past Wednesday, the Fed announced that it was raising interest rates by 0.75%, which is the biggest single increase in 28 years. Around the same time, the government announced that inflation was up 8.6%, meaning that on average, things that you bought this past May were 8.6% more expensive than they were last May. That's the highest increase since 1981. But there's some confusion around that. What actually is the difference between inflation and interest rates? They're related, but they are not the same. Inflation is the increase in prices of things. It's a result of more money chasing fewer goods. And that could be because there's more money available for the same amount of goods, or because suddenly there's a drop in the amount of goods. Either one of those, where there's a mismatch between demand and supply, that drives up prices. That's inflation. Interest, on the other hand, is what you have to pay to use somebody else's money. So if you wanted to borrow money, or if a company wanted to borrow money, interest is what you pay for the opportunity to use that money for a while until you have to pay it back. Interest affects you in terms of car loans and credit cards and mortgages. In fact, mortgages are in the headlines again these days. As recently as 6 months ago, mortgages were floating around 3%. Now it takes mortgages are being written at about 6%, meaning that if you wanted to buy a home now, it's going to be a lot more expensive per month than it was about 6 months ago, because interest rates have gone up so much. The problem actually was that rates were being held too low for too long. And again, when rates are really low, people borrow more money. They feel richer. They have more money in their bank accounts. What the government would call, or what economists would call, money supply goes up. And when there's all that money sloshing around in the economy, people want to buy more things. But it's not necessarily that easy to produce more things in response to that demand. Ask anyone who was producing toilet paper at the beginning of the pandemic. You can't necessarily just ramp up a factory all of a sudden and supply it. And so when there's competition for those things, because people have more money and they really want them, they start bidding up the price. That is inflation. And we have a real problem in needing to control this now, because the government has held interest rates so low for so long. And on top of that, the government pumped so much money, trillions of dollars, into the economy at the beginning of the pandemic, because they were afraid that demand was going to collapse, demand was going to drop too much, and the economy would have damage. And I'm not going to give you any kind of an opinion about whether or not that was a good idea, but the fact is, pumping that much money into the economy suddenly ultimately drives up prices, because you have all that money that people get and they want to spend it. And so they have to go out and try to find stuff. And as stuff starts disappearing off of shelves, prices go up in response. Now, as recently as a few months ago, Jerome Powell, who's the chair of the Federal Reserve, and Janet Yellen, who's the Secretary of the Treasury, were both saying, don't worry about it, don't worry about it, it's a passing thing, it's going to go down in just a few minutes. Oops. I guess they have to say to the president now, oh, sorry, the dog ate my forecast. Anyway, many economists believed that this was not a passing thing, and now it's being proven true. It's going higher than anyone anticipated, and it will probably be with us for quite a while. What they have to do is they have to cut the supply of money, and that's why they raise interest rates. They raise interest rates because when it gets to be more expensive to borrow, people tend to do less of it. Companies tend to do less of it. And so things get pulled back a little bit. So what they're hoping to do is, by decreasing the money supply, the demand will drop, and that will get inflation under control. Now, one big difference between interest rates and inflation is that interest rates will go up and down over the course of time, but inflation tends to go up pretty much most of the time over the long term. There are times when inflation is actually negative, when we have deflation, when prices go down, but those are relatively unusual and they tend not to last for too long. those are in deep recessions or even depressions in the economy. So generally, prices go up. It's just a question of how fast they're going up at any one particular point in time. So what that means is that we can't necessarily hope that prices will go down, except for specific things like gas may go down, and food prices may go down. Those will go up and down in response. Those are more volatile. Those fluctuate more than other kinds of prices. But in general, prices will probably continue to creep up. And the question is how fast. But interest rates go up and down based on a whole lot of things, including the government wanting to speed up or slow down the economy. So what does that mean to you? Well, we want to focus on interest rates right now because those are the things that may be affecting your cash flow more in the short term, given how fast interest rates are being forced up. I said that the Fed just raised interest rates by 0.75% this past week. Chairman Powell said that they'll probably do the same thing next month. So watch for interest rates to go up. And so we want to be careful about what that will cost in terms of your cash flow to make sure that things don't get really seriously out of whack. So here are some things that you can do. Take a look at the debts that you have. If you have debts whose interest rate fluctuates, you may want to consider paying those down a little bit more aggressively, because if you maintain, if there's a large balance on anything, the longer you maintain it, the more likely it is you'll end up paying a lot more because interest rates are going up. It also means that you may want to consider putting off the purchase of something that requires borrowing a whole lot of money. I know it's not, if you're looking for a home, especially if you're looking for a first home, you may not want to hear this, but this may not necessarily be the best time to do that with interest rates going up as fast as possible. One of the other things I will say is that you want to be very careful about adjustable rate debt right now. Now, some debts may go up and down significantly, but they may be relatively small. They may be credit cards or things that you don't carry a big balance on. But you want to be careful, for example, of if you're really determined to buy a home, it may be really tempting to buy one with an adjustable rate mortgage. And right now, that's really risky. In fact, we'll probably have a mortgage professional on the show in the not too distant future to talk to us about this. But for now, what I would suggest is be very careful about that, because we probably haven't seen the top of it yet. And usually with adjustable rate loans like mortgages, they give you what's called a teaser rate, which means an artificially low rate at the beginning of the loan as an incentive for you to take it, which means the first time, first 2 times, first 3 times it adjusts, it almost certainly will adjust up. But if things continue on the way they're going now, with interest rates continuing to go up, they may adjust a few times. Your payment could change dramatically as those interest rates change over the first few adjustment cycles. So we want to be very careful about taking on that kind of debt. Even if it's more expensive, it may still be a better idea to take on a fixed rate mortgage as opposed to an adjustable rate. If we find that interest rates fall back down to where they were before, by the way, not terribly likely. 3% mortgages have not been around since a long, long time ago. So this may still be a decent rate, but even if they do, you can always refinance it a bit down the road. So here's your 30-minute action list. Review your cash flow statement. How much slack is there in there? And how much of that cash flow, how much of your monthly payments go to paying off debts? You may need that slack if the interest rates on those debts goes up. Focus on reducing those debts. Now, you may be tempted to think pay off the highest interest ones first. And there's an obvious argument for that, but I will give you a different suggestion potentially. And that is look at the smallest ones and pay those off first. Paying off a debt entirely and getting that statement that says 0 on it can be a tremendous motivator to continue on. So, sorry, let's get back to the 30-minute action list. Review your cash flow statement. How much of it is to pay off borrowed money? And how much slack do you have in that monthly cash flow? Focus on reducing debts. Think about consolidating debts. If you can find a really attractive offer on a new credit card or something like that, and you have the opportunity to consolidate debts, into something that's a relatively low rate, do that now, while, before interest rates can go up any further. Special case, student debt, separate issue. We should talk about that separately, but generally, if you're talking about credit cards, car loans, those kinds of things, think about the possibility of consolidating some of those debts. And if you have been holding cash, and we've talked about this before, cash, we've had clients holding a lot of cash for a little while now, because a lot of the different kinds of investments we could put it in were not all that attractive. Now is the time when you may want to start thinking about some other things. So if you've got a whole lot of cash that you've had sitting on the sidelines, and you've got a portion of that you might want to put into fixed income or bond-like income generating kinds of things, you might consider taking some of that and buying a one-year CD. Those are way more attractive now than they used to be. Or if you have a lot of money in a checking account or even a savings account, you may want to take a look at money market accounts, because money market accounts have interest rates that fluctuate a whole lot faster than other kinds of bank accounts. Would you like to learn how to develop the skills and habits and make better decisions and create your own plan? Well, take a look at our Field of Vision planning system. You can read all about it at focusedwealthadvisors.com/field. And while you're there, you can download a free paper, 3 wealth hacks that you can put to work today. That's focusedwealthadvisors.com/field. And I will see you next time on 30-Minute Money.